Hello, finance class. This is my first attempt at putting the Foundations in Personal Finance curriculum online via our school website. So hopefully this will work out. I believe that since I'm down here in the corner of the screen, I should be able to avoid any copyrights on the materials because I'm providing commentary as I normally would if we were able to have class. So hopefully this won't get pulled off of YouTube for copyright infringement, and you guys will be able to finish your homework for the rest of the school year. Anyways, that's what we're doing right now. Let's see how this goes. So we're picking up back up in chapter 8. We should all be on page 167. And we're starting video 2.1. We're going to be going over types of investments. So let's go ahead and get that loaded up. Let's see here, 2.1, and here it goes. So let's see, where's my mute button?
Types of investing. Let's look first at CDs. Money market type accounts. A CD is a certificate of deposit, typically at the bank. Now I hear people walk around talking like there's somebody, there's some big investor. I've got me a CD. I've got CDs. I'm doing CDs. This means nothing. You know, when you ever go to school and have perfect attendance, they gave you a certificate. That's what this is. It's a certificate.
I disagree. You guys know I take perfect attendance very seriously. If you got perfect attendance, good job. You deserved it.
Whooping. Okay? You have a savings account with a frameable certificate. That's it. That's all a certificate of deposit is. Now, that's not what a real one looks like. A real one would look more like a piece of paper from a bank, right? That's an actual certificate of deposit there. And these days, most of them are done electronically. You may not even get a piece of paper. You just have a web presence. It's a savings account. That if you take your money out early, they charge you I don't own any CDs, not one. I'm not going to tie my money up and not get paid anything for tying it up. And that's what we end up doing with this. So I don't do that. Instead, I use money market accounts with a mutual fund company, money market mutual funds. They're low-risk money market accounts with check writing privileges. So for my emergency fund, I'm making the same money you'd be making on a CD, about the same interest rate as you'd make on a 6-month CD in a money market account, and I can write checks against it. There's no penalty, and it's just sitting there. It's not an investment, though. Even then, it's a savings account, because we said with the emergency fund, it's not an investment, it's insurance.
So if you'll remember from most of the course, we want savings accounts that keep up with inflation. CDs rarely do that. I believe I showed you guys modern CDs sit around 2 to 3% interest.
Also tend to invest in the company that they're working for. They all invest in sound long-term mutual funds and long-term investments. What I found is that really wealthy people started with little means, but invested systematically over a long period of time in good investments like mutual funds that have a good long-term track record. The really fascinating and odd thing is that it's not that hard. If you take a person that is 18, 19, or 20 years old and they invest regularly over a lifetime, they can become a millionaire. You don't have to earn some amazing rate of return. You just have to be consistent and start early. There are several common traits of millionaires. They tend to work hard. They have a budget and stick to it, and they live on less than they make. They are really, really disciplined about saving and investing. Now, that doesn't mean that they don't do some fun things and spend some money, but they always make sure that they pay themselves first through saving and investing. The last and very interesting trait of millionaires is that they have fanatical integrity. That means that they are fair and honest both in business and in life. It makes sense if you think about it. If you're hardworking, disciplined, and honest, you will win in life.
Single stocks. Single stock investing carries in.
Before we continue, I just want to talk a little bit about what he was mentioning, the integrity of millionaires. That actually brings up something that I like to call the myth of the evil millionaire. A lot of times people try to paint class warfare, and they try to convince you that rich people are evil, and they've done mean, evil things to get your money, and that's how they got on top. And that's often portrayed in media and film, and that's honestly not what I've seen. I've known a handful, not a lot, but maybe I probably count them on one hand, people that make just around or above $1 million a year, and they're very nice, generous people. And then the funny thing is, I call it the myth of the evil millionaire, because people who do things like that to get on top, they usually get caught and they end up in jail. I'm not saying that there aren't any bad rich people, but how much money you make rarely has anything to do with your character. It's just a trend in millionaires that they've been finding in their research, that millionaires are typically more moral when it comes to handling their finances. So I just want to point that out, little thing that I like to talk about. Also, I need to do this every now and again, or else I risk the video getting pulled. So there you go.
I do not own a single stock. If you're a single stock nut, or you just think your company is the best company since sliced bread, and you want to buy some single stocks, you've just got to have some single stocks. You think they're the greatest thing out there, and you and your golfing buddy have got this figured out, and you just got to do it. Well, no more than 10% of your nest egg. So if you have $300,000 in your 401k, you should never have more than $30,000 tied up in single stocks. And I got to tell you one more time, I know a lot about this. I've spent my life studying it. I have zero money in single stocks. I don't think it's fun. It's too risky. And you jump in and out, and there's all kinds of studies that say that the average person buying and selling stocks through their broker over a period of years averages about 7%. You and your golfing buddy do not have this thing figured out. And so it's a bad idea. Mark Twain, he said it this way. He said, October, this is one of the peculiarly dangerous months to speculate in stocks. The others are July, January, September, April, November, May, March, June, December, August, and February. You're listening to the Dave Ramsey Show, America. Thank you for joining us. Coming up next is Monty. He's a junior in college, 22 years old, Pensacola, Florida. Hey, Monty, what's up in your world?
Yeah, not a lot. I have an uncle who does day trading, and he says it's making him rich. Why don't you recommend day trading or single stocks? Because they seem to work for him.
How do I say this gently, Monty? Your uncle is an idiot? Yeah, that's one thing we could say. Here's the deal. 78% of the people who buy and sell single stocks in a given year lose money. People who say they make money day trading are either can't add and don't keep up with their stuff, or they're like, it's like a fishing story. That's what it's like. Every time he goes fishing, he catches big fish. I've never seen any guys like my uncle. He's the best fisherman ever. Well, no, not really. Here's the deal. 78% of these people lose money. So the chances of him actually being the one genius, give me a break. If he was that blame smart, he'd be running a mutual fund. I can tell you this. I've got all these degrees, letters, and licenses and crap after my name that says I'm supposed to know something about stocks, and I do know a lot about stocks and buying and selling stocks. And you know how much I buy and sell single stocks? Zero. I'm a multimillionaire. You know why? Because I don't take chances like that. I don't play with those kinds of things. That's too much risk. Dude, you have a better shot of standing at the roulette wheel and just the law of random numbers making you rich than you do buying and selling single stocks. So best way to do is to find a way to get rich that is steady, predictable, low risk, and do that kind of a thing like long-term investing in good growth stock mutual funds. Hope that was clear for you, sir.
All right. A couple of side notes. Again, this is another staged phone call. His real phone calls are not nearly as nice. Also, that's one of Dave Ramsey's opinions that makes him really unpopular with a lot of finance people, because buying single stocks is a very popular thing, and they clash in ideas. And again, like I said, the reason why we choose this course is because this is what's most effective for just about everyone. And yeah, I'm not going to say it's impossible for people to make money off the stock market. I don't know. I've never done it, but I will say what he recommends absolutely works for just about everyone. So he's got a great point there. Oh, I need to make this commentary slow down a little bit. We're only 6.5 minutes in. All right.
Of ownership in the company. You're buying a piece of ownership in the company. Well, let's do this way for just a second. I'm going to open a company, and I'll tell you what. Let's you and I open a company. What's your first name, sir? Dwayne. It's good to meet you. Thank you, sir. Dwayne and I, as an example, are going to open a printing company. We're going to go in the printing business together. Okay, Dwayne knows a lot about printing. I don't know anything about it in our example. Are you in the printing business? Good. Okay, this is an example, all right? And so he's going to come to me. I'm going to put up a little money, and he's going to go in and do the work and get the accounts and learn about the paper and the ink and that kind of stuff. And so we decide we're going to form a corporation, and we're going to own it half and half, and we're going to issue 100 shares of stock, a share of stock, and he's going to have 50 shares of stock, and I'm going to have 50 shares of stock. So we're 50-50 owners in this company. A share of stock represents a piece of ownership in that company. Dwayne and Dave's, the D&D print shop, right? Okay? And so then what happens to this company, what happens to its value and its profitability as a stockholder and owner of the company, I get to participate in a winner, in winning or losing with that. If I sold a share of this stock to someone else, then as we made money or lost money, then that person would benefit. Now, how does that happen? Well, if you're an owner, think about it. If you owned your own print business, forget stock a second. If you owned a company, if the company did better, you'd be doing better, right? In a couple of different ways. Your return comes as the company increases in value. Now, let's say we go along and we have one little print shop and we're winning, and Dwayne's really good at this, and he goes out and gets a bunch of accounts, and I maybe do the accounting or the financial stuff over here, and he's an excellent printer, and we build up business so much so we can't fit it in that, and we open up another building, and pretty soon you visit us 5-10 years later, and we've got print shops in 6 different cities. Now, is this one share of stock, my 50 shares of stock, worth more with print shops in 6 or 8 cities that are profitable? And I've got all that equipment? Yeah. And so that's what happens. That's how a share of stock goes up in value. If you buy a share of a company like a Home Depot or something, and it goes from $52 a share to $72 a share, it's because the company became worth more, just like our print shop. And you're a little bitty dinky sliver of an owner when you own a share of stock in a publicly traded company.
All right, so this is something that we actually came up in class earlier this week. Oh, whoops. No. Okay, well, I'll recover this while I'm bringing this up. Let's just we'll hit the mute button there. We'll bring the video back up. And so in case this is a future class watching this, the reason why this is the first video and why we started recording this is because this is the year of the coronavirus epidemic or pandemic, whatever they're calling it. I don't know. Who knows what they'll call it by the time you take this course. My guess is they'll probably call it, an overreaction. Anyways, that's my 2 cents. The point is, last week in class, there was a lot of talk about the stock market because, we brought up that the Dow Jones had dropped, I want to say like 2,000 points or something that week. And I was bringing up the point now is probably a great time to buy stocks because this is what's called an artificial drop because like he was saying, the print shop, let's say they open more retail businesses, they start selling more prints. That shows that the company's profitable. The problem is it's not a problem. The stock market is based on how people report their profits almost instantaneously. So it's not that people are only reporting profits, every few years, like his example. They report their profits daily, hourly. The stock market is a constantly trading thing. Day trading is supposedly really high stress because companies' profit margins can change. Now, are these accurate to how good the company is going to be in 5 or 10 years? No, not always. And right now, with this current scare, pretty much all the markets are closed. I think that was the analogy I gave in class. The markets are closed. So more or less, people can't go to his print shop and buy his prints. It's not that they don't want them. It's not that his locations are bad and he made a bad business model. It's simply that the market is closed and no one can go conduct their usual business. However, after everything settles back into a state of normalcy, whether it ends up being that people realize like, oh, okay, hey, this isn't so bad, or they're able to treat all the cases that pop up with this virus, but the market will again return to normalcy, and all those companies that lost those huge drops in stock, they're going to go back to their normal profits, and those numbers of profit will be reported higher again. So right now the stock seems to be losing value because the profits tanked. Some profits are down to zero because they can't conduct business at all. And so now would be a great time to buy because you buy while the market's low because it's tanked. And then as the profits go back up when society returns to a state of normalcy. That company goes back to making their normal amount, whereas you took advantage of the low stock prices and all the panic selling, because that's what a lot of it is. Anyways, that's that. Let me see here. Did I get the right spot on the video? I think so. Yeah, right. I think we're right here. Did we get the value? I think so. Let's unmute.
Became worth more.
Yep. Okay. Here we go. Nope. No. Yeah. Oh no! I just realized I wasn't in the video recorder. How sad would it be if my microphone was muted this whole time? I'm just talking to blank page. Oh no, it's not muted. Great. Whew, that was scary. Let's see here. We finished that story, and where are we now? Did we finish that story? Hold on. Did I go too far? I've got no way of knowing. You guys are trapped now. Good luck. I'm not restarting this video. This is like my 4th time trying to record. It's not going back. You're stuck with me. Where did I stop at? I thought there was a screen cut somewhere. Wasn't there a thing that popped up with oh wow, was that the end?
I'll make 8% on that. I might end up making a mess like I'm doing right now. That could happen.
What? No, he didn't do that.
Aluminum made money in those days. He participated in the profits by getting dividends checks. Now,
okay, you know what? I can't remember if we made it to the end of the video or not. Wait, let me check the screen cap. We're at 16 minutes. Yeah, it's possible we made it to the end of the. No, it's not possible at all. We stopped somewhere there. All right, so we'll just redo the. We'll go through the answers real quick. I'm gonna take this. I'm gonna make me larger. Haha, I can do that. And let's see here. If you were on page 168 under bonds, a bond is a debt. Your return is the fluctuation in price and the interest rate paid. Few individuals do well with single bond purchases. All right, and then page 169. No, that was the end of this video. Okay, so those are the last three things. Oh, I've talked about bonds before. Yeah, a bond is a debt instrument by which the company owes you money in the form of an IOU. And this is what you'll commonly see on ballot tickets. It's my most frustrating thing that I ever vote on as an adult, and you'll see it too, especially since we live in the state of California. California is constantly trying to create bond measures to put us in future debt. It's problems for future California, not current California. I think we were just talking this week how I voted no on a measure to create $15 billion of bonds for the state. That's political speak of saying the state wants to put $15 billion of debt onto our budget, or $15 billion of IOUs in order to fund something that the state wants to do. Not a great idea. Anytime I see something like that, I usually run for the hills. But that's more or less what a bond is, because whenever the government puts out a bond, we're all kind of collectively sharing that debt with our taxes. Anyways, so when it comes to a bond, your return is the fluctuation in price and the interest rate paid. So whatever the government pays interest on the bond, that's what those companies would receive. And few individuals do well with single bond purchases. Again, that's why Dave Ramsey, you're going to hear him over and over and over again. He's gonna preach money markets and mutual funds, mostly mutual funds. But yeah. Hey, here we go. The top of page 169. Examples include treasury bonds, a bond issued by the U.S. government that bears fixed interest, and savings bonds in the United States, a bond that can be bought from the federal government. So that's where those bonds go. Bonds are typically low risk and low return on investment. So not exactly the best way you can go. All right. Well, that's it for this video. I'll cut you guys loose since you've been staring at me for 20 minutes. And maybe I'll talk less on the next video. All right.